Are you wondering why everyone's talking about interest rates again? What mysterious force causes mortgage rates to fluctuate? Spoiler alert, it has something to do with the Federal Reserve. Stick around because in the next few minutes, we're breaking down what the federal funds rate actually is, how changes are decided, and most importantly, what it all means for you as a buyer or seller in today's housing market. Hi everyone, welcome back. I'm Taya Mower with Mower Group Realty, and today we're diving into a topic that affects all of us, whether you realize it or not. The federal funds rate. Now, before you hit that snooze button, I promise this won't be one of those boring financial lectures. We're going to break it down simply so that even a donkey can understand it. Well, not really, but you get what I mean. So first things first, what the heck is the federal funds rate? In super simple terms, it's the interest rate at which banks lend money to each other overnight. It's essentially the cost of borrowing money for the banks. But here's the kicker. It has a ripple effect across the entire economy. When the Fed changes this rate, everything from your car loan to your credit card, and yes, even your mortgage rate is affected. Ever wonder who's really pulling the strings when it comes to changes in the federal funds rate? Enter the Federal Reserve, also known as the Fed. No, we're not talking about those feds. That's a topic for another channel. The Fed operates through the Federal Open Market Committee, or the FOMC, which meets 8 times a year to evaluate the health of the economy. If the economy is overheating and inflation is too high, they raise rates to cool things off. But if the economy is slowing down, like we've seen recently, they cut rates to stimulate spending and investment. It's like the Fed controls the economy's thermostat, constantly tweaking it to remain in balance. Now here's where things get really interesting for real estate. The federal funds rate doesn't directly control mortgage rates, but they often move in the same direction. When the Fed raises rates, banks tend to hike mortgage rates to offset their own rising costs, which is why we've seen mortgage rates climbing in the recent years. Higher mortgage rates mean home loans become more expensive and buyers' purchasing power decreases. And on the flip side, when Fed cuts rates, just like they did by 50 basis points, mortgage rates usually drop, making home loans cheaper and boosting affordability for buyers. But here's something most people don't realize. Mortgage rates don't always react after the Fed makes its move. Lenders often bake in anticipated projections into their rates before the Fed's announcements. For example, with this latest rate cut, we saw mortgage rates improve ahead of the actual decision, and then they stayed steady and even ticked up slightly after the news. So what does this all mean for both buyers and sellers? Well, this latest 50 basis point or 0.5% reduction in the federal funds rate offers a significant window of opportunity, as lower Fed rates typically lead to reduced borrowing costs across the board, including home loans. Just remember, it's less about timing the market and more about aligning your goals with what's happening right now. For buyers, this reduction translates into lower mortgage rates, resulting in a smaller monthly payment or a bigger budget for your dream home. A simple rule of thumb from my trusted lender is that a 1% change in interest rate equates to a 10% change in your buying power. So if you've been sitting on the fence, now is a great time to explore options. However, don't fall into the trap of trying to time the market perfectly. Waiting too long could mean that rising home prices affect the benefits of lower rates. And if today's rates aren't quite what you're hoping for, remember that creative financing options like interest rate buydowns can help you now, while no-cost refinancing later can allow you to capitalize on potentially lower future rates. So dust off that loan pre-approval or start the process if you haven't yet. Get a clear understanding of what you can afford in today's market, and don't hesitate to explore creative financing options to stretch your budget further. The key is to be prepared so that when the right home comes along, you are ready to move quickly. Now for sellers, lower rates bring more buyers into the market, increasing demand for your property. However, as more sellers enter the market to capitalize on this opportunity, competition could rise, keeping prices steady instead of soaring. The key is to stay strategic with your pricing to attract eager, able buyers while maintaining an edge over the competition. So do yourself a favor. Stop allowing online valuations and media headlines to influence your decisions. Call a trusted local agent who knows your market. Get the real scoop on what's happening in your area and discuss strategies around pricing, timing, and how to make your home stand out in a competitive market. It is all about positioning yourself for success, whether you're looking for a quick sale or top dollar. Long story short, regardless of whether you are a buyer or seller in today's market, do not wait for the stars to align, because timing the market perfectly is like trying to predict the weather a month from now. Get out there, explore your options. After all, dreaming is free and education is priceless. What do you got to lose? The good news? You don't have to do it alone. All of us at Mower Group Realty are here to help you navigate the process, from exploring creative financing options to refining your pricing strategy to connecting you to a professional in your area. Drop your questions in the comments below, subscribe for more insider tips, and reach out to us to start planning your next steps. That's it for today's breakdown of the federal funds rate and its impact on the housing market. Remember, it's not about waiting for the perfect moment. It's about making the right move for you. Thanks for tuning in, and don't forget to subscribe for more real estate insights. We'll see you in the next video.